Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Happy Monday. Welcome to the show. We are going to talk again about labor markets because this is really at the heart of what is going on the macro front this week. There are, of course, a lot of different stories jumping out there. If you were tuning in for overtime with our friend Chris Vecchio, head of futures and forex, just in the past hour, that show running for an hour before Macro Money, Monday through Thursday every week, we were talking about this story with the jump in crude oil that ultimately ended up not finding follow through, the various situations still brewing at the banks, the inconsistencies with the moves in some of the major currencies against the dollar. But all of this really boils down to just a couple of pieces of economic data this week. And the main takeaway from all of this data, of course, becomes, are the markets in the wake of SVB and in the wake of the recent turmoil wrong about inflation, wrong about the Fed, and therefore are pricing assets not where they ought to be? And is there then an asymmetric risk in the dollar, in U.S. stocks, in bonds, in gold, you name it? This is, of course, the formative narrative for everything. And the pieces of data that are going to inform this come to us this week, of course, via the U.S. labor market, the sort of central point, the ground zero for the inflation narrative. And interestingly, the main release, of course, the non-farm payrolls and unemployment rate numbers that are going to come out of the official jobs report due this week, they're coming out on Friday. And Friday is a market holiday. Good Friday. So we're not going to have any kind of immediate response other than perhaps from those markets that are going to be inherently open because they're over the counter. So, for example, spot currencies. But outside of this, spot gold, I suppose, as well. But outside of this, we're really not going to have a U.S. stocks response to what this data is going to do. So instead, we are going to look at a number that comes out tomorrow and is very much a part of this story, and indeed is possibly more formative for an early view at what's going on than even the official figures. So I am speaking, of course, about the JOLTS job openings or vacancies number. You can see here in the green, the trend there. We are still tremendously high on job openings. We're expecting to come in from about 10.8 million to 10.5. So a bit of a downswing here, not an aggressive one, and very much within the realm of the recent values, which, as you can see here, are somewhere between 10 and 11 million. Which by historical standards is enormous. If you compare where we were before COVID, we were looking at 6 to 7 million. And if we look before 2018, which is not even on this chart here, we were looking lower still, somewhere in the vicinity of 5 to 6 after the global financial crisis. But before the 2018 Fed easing cycle. So what we're looking at now is a huge amount more job openings than recent history. And what you see then is this is contributing to inflation expectations. So overlaid with the job openings here, you have the 2-year break even. As we've talked about before, this is the difference between nominal bond yields and inflation adjusted or real bond yields. When you take the difference between those two, you extract the magnitude of that inflation adjustment. And that gives you the bond market's inflation expectation. We've taken the 2-year here because that's, of course, right in the Fed's policy decision window. This is forecastable medium-term inflation for the Fed that they're aiming to get down to 2%. You can clearly see at 2.7, the market is saying the Fed not only hasn't done its job fully, it's ostensibly under-tightened and needs to do more. Now, why is this relationship there? Let's review a couple charts here. So this is the current situation on labor supply versus demand in the US, which you can see after COVID has really had some dramatic things occur. So in the dark line there is labor supply, and that's the amount of people currently in work and the amount of people looking. You're not considered unemployed if you're not looking. So that's the amount of people that either have a job or want to be in a job. In the red, you have the amount of people working again, and then that JOLTS openings number, the amount of people that companies want to be employing. So you can see that where this really turns, the big difference here is really in that number of job openings and the number of people looking. And of course, we know that the unemployment rate is near historic lows. The expectation is we're going to register at 3.6 again this week, which is just a hair off the multi-decade low at 3.4. So we know that the number of unemployed people amongst those looking is very low. Now, of course, amongst those not looking, this math would look different, but they're not looking. And so, granted, we're painting with a bit of a broad brush because this is survey data, so it doesn't take into account every individual case. It obviously can't go out and poll every single person of working age. So there's some surveying and then extrapolation here. But the big picture is that what this whole thing hinges on, in large part, is that job openings picture. Are we going to stay near record high job openings, and why is this mismatch occurring? Well, part of it is the accelerating trend in baby boomer retirement that, of course, we've talked about at length here on Macro Money, that really got going some years before COVID, and you can see on even this chart, right around 2017, mid to late 2017, the red line, meaning demand, starts to outstrip supply. But the margin is very narrow. And then when COVID happens, that margin really widens out. So you can see here that what's going on here is before COVID, there was a trend toward baby boomers, which are increasingly becoming of retirement age and are still the largest component of the labor market, starting to exit. And so you start to get a bit of under supply relative to demand. You can see that here. So you can see right around the middle of 2017 going into the second half. And what I've done here is I've actually taken the difference between these two lines and I've graphed it here against inflation. So when supply outstrips demand, the bars go up. And you can see during COVID, labor supply was significantly outstripping demand. So you get those tall gray bars there. And of course, after COVID, and as you catalyze inflation higher, you get a situation where demand significantly outstrips supply. And you can see before COVID, you were getting some of that dynamic, but very, very mildly so. And of course, now you've significantly changed the scale of what this is. And so this is really the sticky part of inflation that the Fed is most concerned about. If you have a mismatch in labor supply versus labor demand, such that demand outstrips supply to this kind of dramatic extent, well, how can those employers compete for labor? Well, the only way to do it is on price. What's the price of labor? Wages. So if job openings, to bring it full circle, remain highly elevated, if that continues to feed this mismatch in labor supply and demand, well, then wages stay up. And if wages stay up, well, then the labor cost to doing anything stays up. And that, of course, finds its way into the final price of goods and services and looks like inflation. So you can see that the Fed has successfully brought inflation down, looking at either the PCE or the CPI measure, somewhere into the 5 to 6% range. But where it isn't is 2%. Now, part of this, surely, is the lag in monetary policy. And indeed, we are seemingly heading in a direction, you can see here, where things are cooling from their most aggressive readings, let's call it in the 8, 9, 10% range. But as long as this mismatch holds, getting back to 2% is going to be very challenging. And if job openings remain elevated, that means the inflation problem isn't really going away all that fast. So that's going to be a critical number to look at this week, because in the wake of SVB, the markets are convinced that the Fed doesn't need to fight inflation any more vigorously than it already has. So you can see here, the yield curve before SVB was much more significantly skewed higher, especially over the 6-month window here, and was going to land us at rates that are higher too by the time we get to 3 years out. But in any case, we were looking at rates well in excess of 5% going into next year. Since then, you can see the curve has significantly shifted and hasn't really moved very much week on week. So we're about stable or stabilizing here, it looks like, with a terminal rate just sub 5%. So about 4.9 is what we're seeing now currently, all the way out to 3 months. So it looks like we're going to hover around here and then start considering cuts 6 months from now. So October, November is where it looks like the first round of cuts starts, and then you move out sub 3 over a 2-year period. So from the looks of it, it appears that even in this scenario, the Fed is done. But if job openings hold up, and this continues to be the case, that, of course, raises an important question. Are they, in fact? So in the wake of SVB, you can see the OFR Financial Stress Index has started to get better. It started to come off. Last week, it spent most of its time kind of hovering around the peaks of the spike. But they've since decided, it looks like, that the situation is more manageable. And with every day that we don't get another bank failure, maybe that's something that makes sense. And so you can see that as the OFR index of financial stress has come in, so too risk appetite has improved. S&P 500 has been going higher in near perfect inverse. But what you haven't seen is that as that same index comes in, Fed rate hike odds have grown. They have not. they're still holding around the same anchored area that they were in after the spike. That's the 12-month Fed funds future implied rate, so 1 year forward from any given date. And you can see we've basically been oscillating around a neutral rate of about 4% 1 year forward. The problem with this, of course, and we got a little bit of a preview of it in the first chart looking at where break-even rates are, we're at 2.7%. It's a little bit down from the 3.2 we saw in February before all of this mess with the banks. And it is certainly the case that inflation numbers have been coming in. You can see that they tend to lag the break-even rate by about 2 months. And that's, of course, because the inflation expectations are real time in bond markets, and also because it takes time to gather survey-based inflation data and actually publish CPI and PCE. So there's a little bit more of a lag there. But you can see that the market fairly closely anticipates, with about a 2-month lead, what's going to happen on headline inflation. And it looks like this last go-around may be the bottom before a reacceleration. Because if we look at what is being foreshadowed in that 2-year break-even in February, in March, and now going into April, we're looking at readings closer to 3 than they are to 2. Which again, tells us that the Fed is not getting done what it needs to get done. And so one naturally asks, well, does this make sense? Does it make sense that as the risk eases, Fed rate hike odds have not rebuilt? One argument to say that, you know what, the Fed rate hike odds are right. They are done. They should be done, is that indeed the pullback in inflation has been consistent with a topping out and a slowing of overall global economic activity. And the proxy for that we're looking at is total global trade volume, exports plus imports internationally. So how much goods and services are being bought and sold across borders, sort of taking a really, really big picture view. And you can see that higher Fed rates and higher borrowing costs in general, as other central banks follow the Fed, they have indeed put a cap on global economic activity, and inflation is indeed down. You saw that in the ISM data that we saw just earlier today. So from the manufacturing side of things, we continue to have the consequences of what the Fed has done to global economic activity. So you can see employment sub 50, and of course, recall in the logic of PMIs, 50 is the center line. 50 is neutral for growth, whereas above 50 is expansion, below 50 is contraction. The further you go above, the faster the expansion. The further you go below, the faster the contraction. And what you see across the manufacturing ISM numbers today is that, first of all, you're in contraction territory all around. Second of all, at 46.3, you're at the lowest level since May of 2020, so at the heart of the COVID outbreak, at the worst of it, almost the worst of it. April was arguably a little bit worse even than May, but you're right there in that difficult area. So the manufacturing sector in the U.S. is shrinking at a relatively swift rate, and you can see sub 50 numbers for prices, for employment, for new orders. So clearly, this part of what the Fed is doing seems to be working and seems to be bringing inflation down from 8-9% to 5-6%. But overall economic data continues to surprise mostly on the upside. The overall setting of the U.S. economy that really started to reaccelerate in February and gave us that significant extrapolation in Fed rate hike odds before SVB and all of that occurred, that remains. And that's because the majority of the U.S. economy is services. 3/4 of the U.S. economy and the people working in it are employed in services. And so later in the week, you can see we're going to get the service sector PMI, and here we're expected to come in just a tad from 55.1 to 54.5. And if you look at the numbers for employment, for prices, for new orders, they're much more elevated. In the 60s, as a matter of fact. So you're looking at a situation that still looks like it bids up inflation to a significant extent. And so then the question becomes, well, is the Fed, in fact, going to be forced to deal with this? Because what this is doing, and we'll see, of course, how these ISM service sector numbers come out, but what this is doing is it's making for these numbers staying elevated and for inflation staying strong. So then if these numbers for job openings come in and they're anywhere in line with expectations or anything shy of something catastrophically negative, which looking at this suggests isn't likely because U.S. economic data, according to this, has been tending to outperform expectations. Well, then you're looking at an inflation issue here that remains, and a Fed outlook that looks off sides. Let's look at what that Fed outlook is. We are currently looking at a peak in rates essentially next month. So already you can see there is only a 65% likelihood of another hike for May. So you can see percent hike cut column there, 64.8. And the implied rate delta column, 16 basis points. So 16 basis points out of a 25 basis point hike have been baked in. So we're very narrowly better than even on expecting a hike, but very close to a 50-50 outcome. When you get to June, again, about 14 basis points extra baked in relative to where rates are currently. So again, you are looking at maybe in May and June you can cobble together one more hike. For the moment, it's about a 50-50 shot, give or take. Come July, ostensibly the peak is in. And as you move further out, you start to see that in September, about half a cut is baked in. By November, and we talked about this when we were looking at the yield curve just moments ago, by November, the first cut is priced in. By December, 2 cuts are baked in. At that point, we're already at 4.5, slightly under 4.5. So ostensibly, we're in that 4.25, 4.5 range. By December, we're at 4.3. So we're really in that 4.25, 4.5 range and closer to 4.25. By January, we have a full 2 cuts in and an 80% chance, 81 if we round it up, of having 3 cuts. So you can see in that number of hikes cuts column, you're down 2.805, where the 2 is 2 standard sized 0.25 basis point or a percentage point cuts or 25 basis point cuts. So you're talking 50 of those 50 basis points already in, 2 of those cuts already in. and an 80% chance that you have at least one more. And you can see the implied rate change is 70 basis points. In the implied rate delta, you're down 0.701. So you're down 70 basis points expected from the current rate. 3 cuts would be 75. That's why it's 81% chance, not 100. You're just 5 basis points shy from having baked in fully 3 cuts by then. So the market is operating on the assumption that the Fed is done and that the next step is a significant easing cycle. But if job openings remain elevated, then inflation remains out of the Fed's reach for a 2% target, because services remain robust for the most part. And what the Fed then needs to do, perhaps, is more, or at least to hold rates higher longer. So maybe we don't get necessarily rate hikes baked in for the next month or two, but maybe this 70 to 75 basis points in cuts by the back half of this year, maybe that's wrong. And then there is a readjustment. And in that kind of a readjustment, any recent weakness in the US dollar makes for a lot of room to correct the other direction. Recent strength in stocks makes for room to correct in the other direction. Recent strength in gold makes for room to correct in the other direction. And of course, benchmark yields are likely to come up. So the pop we saw in bonds, be it ZT for the front end, ZN or ZB for the back half, the longer end of the yield curve, the 10 years and longer. All of that starts looking like those bond rallies may struggle because yields come back up. And so if this job openings number, especially in the absence of a non-farm payrolls number that markets can react to later in the week, if that suggests that the labor market is still tuned in an inflationary way, and to some extent the service sector ISM number as well, if that holds up, and it suggests that the markets are still tuned in an inflationary way, but these Fed policy odds don't reflect that, there could be a significant correction of recent moves in the days ahead. And that is macro money for today. As I mentioned earlier, we are here every day, Monday through Thursday, just after overtime, with Chris Vecchio, head of futures and Forex here at Tasty Live. I'm also on Fridays with Chris for Futures Power Hour. I am on with Tom and Tony on Sundays for First Call. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much, everybody. Thank you for joining. Godspeed. Happy trading. See you tomorrow.